Um, Hello, welcome back to the continuing lecture series in Principles of Finance. This is Dr. Jeff Hong, and we are continuing our discussion about uh, the uh, how we measure the risk, especially the systematic risk, right? So our last discussion was basically um, uh, we left it off where I was showing you this scatter plot between the uh, two variables, uh, and one being the market return, and the other being the return on a particular uh, stock of company X, right? And so this scatter plot, each dot in this scatter plot represents the coordinates, right, between uh, market return and the return on the company X, right? And I said basically the reason we are looking at this scatter plot is because the scatter plot would give us some clue as to whether there is some correlation between the market and this particular company X, right? And I've been telling you, um, if there is any correlation, right, the correlation would be either positive, zero, or negative, right? With the zero correlation meaning, there's absolutely no correlation whatsoever. And that correlation is captured by the trend line, because if you see a scatter plot like this, and approximately, right, you can um, see that there's a trend, right, and the trend is upsloping, right? It is going in an upward trend, right? Um, well, I don't have other picture, but if the scatter plot shows, if the scatter plot looks like this, that shows a downward trend, right? But and if there is no identifiable trend that, like the plots, the dots are all over, right, with no particular trend, identifiable uh, trend, right? And that means there's no correlation. But at least in this example, these uh, plots form an upward trend, right, or an upsloping trend, right? So we want to identify basically, a trend line, right? I mean, not just um, because everything is kind of, just look. We that there's some identifiable trend, but without any without any specific line that captures the gist or the spirit of the trend, to put it that way. Without any particular line, then it's just like a nebulous idea, right? Just cloudy, foggy idea. So we have to capture uh, the best fitting line, right? The line that would represent that trend best, right? So that's called best fitting line. And that is what, and if we find, and if we can identify such a line, the line will be represented by two characteristics. One is the slope of the line, slope, and the slope is called beta. Isn't it what we were talking about last time, right? In a linear function, what does the linear function mean? Linear function basically represents the correlation between x and y. Isn't that right? And what determines that correlation is the correlation coefficient. Correlation coefficient. In this case, 3.5, which means whatever x is, right? Whatever the x value is, y value depends on that x and the correlation coefficient. So if x is 2, right, y will be 7 in this, and if x is 0, y will be 0 as well. If x is 20, y will be 70. If x is 15, right, y will be 52.5. So basically, one characteristic that would capture the or represent the characteristics of the line trend is the slope coefficient, and that slope is generally called beta, right? And as I said in the previous example, this was, the coefficient was already given. In other words, in this example, slope was given, and the vertical impact was already given as 0. And then because you already have deterministic trend coefficient, all the dots, all the plots would fall neatly and perfectly neatly on a straight line, right? Because the plot didn't exist before. The plot wasn't there before. The equation of the line was there before, and the plot is the result of the equation of the line. But I've been telling you, reality isn't like that. Nobody in reality, the equation of the line isn't given ahead. You understand? And what you're trying to do, what we're trying to do is to identify this equation of the line from what? From the scatter plot that is given ahead. And the scatter plot is the result of our observation. We looked at the market return over the last 5 yearly returns, and each time when market return was at a certain level, what was the matching corresponding company X's return level, right, for each level of market return. And each dot represents that. So these dots were given before the equation of the line. No equation of the line is given. And we are trying to figure out, right? We are trying to identify this line, trend line, from the given data. Okay, so the process is actually reversed. You understand? From the middle school example, 7th grade example of linear function. You are given the equation of the line, and you just plug in the numbers, and you get the y values. That is the middle school way, right? Grown-up way is not like that, because grown-up, for if you're in a Goldman Sachs, doing the research for the stocks, right? You're trying to find the beta, basically. Why? Because this gives you a deterministic trend. Why? For example, if you have this trend line, if you know this trend line, and you identify, as I said, the trend line by two characteristics or two properties. One is the slope of the line, right, which is beta, and the vertical intercept, alpha. The other one is alpha. Where is the alpha, right? Where does it cut the vertical axis? And so if you know the trend line, then what can you do? You can forecast. You can make a forecast. Why? Oh, well, then, if the market return is something like this, let's say this is like, 15%. What if the market return is 15%? And let's say this slope of the trend line is 2. It's not two. It looks more like not even one. But because why? If it is one, if the trend line is one, if the slope is one, what do you see? You will see a perfectly 45-degree line. 45-degree. Why? Because if the beta is one, slope is one, when x is one, y will be one as well. I mean, ignore the alpha. Alpha, uh, let's say vertical intercept is zero. Then because there is a if slope is one, there will be a perfect symmetry between x and y. Because there will be a perfect symmetry, then um, uh, the line will show a perfectly 45-degree angle. This isn't even 45 degrees. It looks like something like 30-degree angle. So I can say uh, just based on this graphic representation, the slope cannot be even one, but let's say the slope is two. If the slope is two, and if market return was 20%, what can you tell about the stock's return? The stock's return would be, if this is 20%, and this point will be like 40%, right? Two times, 20%, right? And of course, it may not always be true because out of all these plots, how many of those dots fall exactly on the trend line? Not too many. There's something close, something close. This falls almost on the line. This falls almost on the line. This falls exactly on the line, close to the line. So there's no way everything will fall exactly on the line. That can only happen only like in the middle school, right? When you already have, right? That's an amateur, right? When you already have the equation of the line and there is no, uh, it's not like you're, so this is like deductive or inductive, right? Deductive approach or inductive approach. This is a deductive approach. In other words, you have the guiding principle. You have the equation of the line. So then you plug in the number, you plug in the x value, you get the y value, and everything will fall neatly on the line, straight line. But this is inductive approach. You understand? It's inductive, meaning, from the given data set, right? From the given data set, you are trying to find a hypothesis or theory would govern these phenomena. Make sense? So that is more grown-up approach, right? Children can do that. In other words, I'm not saying deductive approach is inferior. It's more, it's as difficult as inductive approach. But what is this? This this example is a case where you already have a theory. You already have a formula, or theory that a formula that implements the theory. So all you need to do is then plug in the data, and you get x data, and you will get y value, right? If the theory already exists, then you can do that. But what we are trying to do there is, there is no theory. But from the given data, you're trying to formulate a theory. You understand? So if the theory is already given, just implementing the theory is something even a seventh grader can do. You plug in the number, x values, you get the y values, right? Okay. But this is not something a seventh grader can do. You understand? This is, only people with grown-up intelligence. You're saying, oh, we're all grown. No, not at your, how many of you, I mean, if you follow this, then I would say, okay, then you have a grown-up's brain and grown-up's way of thinking. And if you're still struggling, getting what this is all about, then your intellect is not on that level yet. Okay, but I've been trying to put it into as plain a language as possible, hoping that the majority of you would, get it. And I'm pretty much sure, at least more than 50% is getting it. So this is more of a thing to do, right? And if you're working in for Goldman Sachs, and if you're in a research department, or even if you're not in a research department, security analysts would do this, right? They would find, okay, so what is the beta, and what would be the alpha, and that would give you the power to predict or forecast, right? What if the market return is something like this? What should be the right X value, company X's return? In other words, this process is called regression, right? Linear regression. And then, of course, forecast isn't the actual right? For example, in this case, there is only one there's only one data plot that for this point, right? When the X is, the market return is this, right? The company stock X return is estimated or forecasted or predicted to be this. They all mean the same thing. Estimated, projected, forecasted, and predicted. They all mean the same thing. This is, in other words, projected. But then the reality may be different, right? Because we're using the past data, you can tell the past has already happened. So in the past, when X was this here, right? Let's say when X was at this level, market return was this level. What happened in reality was stock X return was actually this. Or even here, in the past, when X was this level, market return was this level. Stock X's return had three different variations, right? At one point it was like this, another point it was like this. So in other words, reality was different, and in the future it may be different. But it is the given the past data, this is the best we can rationally forecast. This is the best projection you can rationally make. Understand? So in other words, forecast may not exactly nail it, but at least it is better than nothing, and it's rationally the best. Rationally, right? Based. So our next question is, so that's what we want to find, slope, the beta, and then alpha. And how do we do that? We use a technique called OLS, ordinary least square, which is a regression technique, which is statistical method. So in this class, we have limitations to do that, but you will be, if you have time, I'm gonna show you, but it will be running a regression will be for beta, and alpha will be discussed in the Finance 300. Now, but mathematically and statistically, beta, how do you calculate beta? The formula for beta is covariance between x and y and variance over variance of x. And statistic, and with the Greek characters, you understand what this is. This is standard deviation. This is what? Variance, right? variance is the square term of the standard deviation, right? So if there is no squared right here, sigma x is the standard deviation of x, and then sigma x squared is the variance of x, right? Now you need to understand what covariance is. I'm going to get to that later, but doesn't this remind you of something? What does that remind you of? You remember rho? What did I say? What was rho? Rho is the correlation coefficient between two random variables, x and y. And you might wonder, oh, isn't that the same thing? Aren't we talking about x and y? No, here, the difference is, although I use x and y, and x being but the difference is, here, x is the market return and y is the individual stock's return. What's the difference? Remember, what is a linear function? Linear function is not an equal not about an equal relationship between x and y. X and y are not equal. What is that? X is the independent variable. Remember? And y is the dependent variable. Why is that called dependent variable? Because y cannot vary on its own, right? Y cannot change on its own. You understand? The change in y is a result of change in x. That's why x is called independent variable, meaning x vary independently on its own, right? X is a random variable that changes on its own, whereas y is a variable, and the change in y dependent on x. So the change in y is a result of change in x. Change in x causes change in y. Okay, that is a linear function, right? In linear function, y doesn't cause change in x, right? Dependent variable cannot cause change in x. But independent variable causes change in the dependent variable. So if you think about it, and I've been telling you, the market is a formidable force, right? No company is free from the market. When the market goes down, it takes down all of this altogether, all companies together. In other words, that's the macroeconomic system, isn't it right? If the economy is going into recession, most companies are also going into recession. And I've been telling you, most companies are cyclical. Most businesses are cyclical. They go together with the business cycle, follow the business cycle. And during the boom, companies do well. During the downturn, companies do poorly, right? Although I said there are some counter-cyclical stocks, right, that move against the market. So that's why we've been trying to nail down this correlation between the market and particular stock. But also, we already talked about the correlation between X and Y. In other words, in that case, X is not the market, but X is a company, Y is another company, and the correlation between the two is not one. It's not one way. It runs both ways. The correlation runs both ways. Remember that. Why? Because we talked about that because of the unsystematic risk. Because unsystematic risk can be diversified away, right? The portfolio diversification minimizes, right, the unsystematic risk. So drastically, the portfolio risk drastically drops. But what goes down is through diversification is the unsystematic risk. And I told you, systematic risk still remains. And the reason the unsystematic risk is going down drastically is because of the correlation between these 20, 15 to 20 stocks that are all either very low, if you construct them, the low correlation or high correlation, negative correlation, they all cancel out each other, right? So the rho is the correlation, right? Okay, so where did I put the? But then, how you calculate the rho, right? Here I explained that. You see this? And you saw that before, right? And there, covariance. At the time, it was covariance between x and y, and standard deviation of x and standard deviation of y. Remember this, right? Remember this? That's correlation coefficient of x and y. In this case, what is the difference between rho and beta? If you remember what was there in beta, numerator is the same. It's the covariance between x and y, but at the bottom, in the denominator, it was not the standard deviation of x and standard deviation of y. It was variance of x, right? It's the variance of x. So that means x is the independent variable, right? But in case of they are both independent, right? So instead of variance of x, then there was standard deviation of x and standard deviation of y. But think about it. What's the difference? I mean, variance of x is what? Standard deviation of x times standard deviation of x. So look, it's still variance, right? Rho, in case of rho, is still the same thing. The only difference is that instead of sigma x times sigma x, rho has sigma x times sigma y. Make sense? Okay, so that's the difference between rho and beta. Also, intuitively, rho is the correlation between two companies, x and y, and beta is the correlation between a company and the market. Market is x in this case because x is the independent variable. Company is y because the company is a dependent variable, right? So by running a regression, I mean, you can calculate it to calculate covariance and variance, you need to do this anyway. So as long as you have to calculate all the, you do this, you have generate a difference term, data table of difference terms and square difference terms and things like that. As long as you have to do that, it's better to simply run the regression. And if you run the regression, so here between Apple, that was, and this sample was this example was taken in, I believe, several semesters ago. So this is not the most current one, but based on the 2015. Look at this. Between 5 years between and I truncated in the middle. See, because of course there's no way you can put 60 months, 5-year data, monthly data. So there will be 60 data points. I cannot put it in a slide, right? So I truncated in the middle, right? So you see the missing values. Missing values are from July of 2011 all the way to June of 2015. So it's truncated, right? It's only visible in Excel, and then so that based on that time period, 2010 through 2011 through 2015, and the then Apple's beta, and this Apple's beta was 0.0 87. So I've been tracking Apple. I've been tracking Apple since like 2007 or 2005. So I have, enough data accumulated over like 15 years at least. And then as I have watched Apple over, for every 5-year period, every semester, right? Apple's beta has drastically changed. Early on, around 2007, Apple's beta was greater than 1, right? It was like 1.5. And then towards the later part of 2000, now beta is even 2019, Apple's beta is almost about 0. 0.8. So what does that mean? Beta can have three ranges of values it can take. Also, so can rho. Rho can take three, remember, positive, 0, negative, right? And in case of beta, right, it can be positive and greater than 1, right? Greater than 1. What does that mean? So suppose beta is 2. What does that mean? If beta is 2, that means when market goes up by 10%, right? Apple, this stock, let's say Apple. If Apple's beta is 2, what does it mean? Apple's return goes up by 20%. The correlation coefficient is giving you that power, power of forecasting, predictive power, right? In other words, how rational and scientific and how powerful this is. When you say, when the news media interview the experts, right? So what do you think this is? What would be the magnitude of increase or decrease? How much the sales going to change? You think Apple's been doing well, so for the last, how much the revenue will increase? Do you expect? And if those executives are being or researchers being interviewed, right, are saying, based on the model, I think, Apple's, when based on the model, what model? This is the model, right? And if you're a trained finance professional, trained economist, if you're trained mathematician, trained statisticians, trained physicist, you can base it on the model. And this is, basically based on the data, the best forecast we can formulate, best projection we can formulate. But if you go to a store manager and what do you think? Apple, go to an Apple store and ask the store manager, how much do you think the sales is going to sales are going to increase next quarter? Say, the best they can say is based on my experience. And otherwise, if it is not based on their experience, it's just a wild guess. Even if it is just based on their experience, it's still not a rational expectation. It's just a right gut feeling, hunch, right? There's the difference between science and just wild guess. You understand? And it's not. It doesn't carry any weight if the Apple Store manager says, I guess it's gonna go up by 20%. Most likely, maybe. I mean, I'm not denying or I'm not, belittling or declining their experience. I mean, their experience has something, obviously based on, past performance. So, but then That's not a forecast based on uh, scientific model, right? You understand? That's the difference between a trained people, educated people, and untrained people. Training is very important. You think some people think uh, on college, I think a lot of some complaints from some students who are more on a very emotional side, and they are just crying all the time, complaining all the time. They don't do their duties, just they don't do their due diligence, but just when they are chided and um, reproached, then they just complain. You are adding stress, blah 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 blah. That because they are lacking. And who are they talking to? Huh? I'm the professor, and it is the part of the responsibility of the professor to chide and reproach if the students are not doing things in the right way. And also, it's a role of the trainer. I mean, think about it. This is a rigorous training. This is not a touchy-feely, psychology or literature. I mean, um, you know, you are you are not a don't the students are complaining they cannot stand up like a grown up. A grown up is what? Who can someone who can handle their own emotional state, who can control, or at least uh, who should be able to tell the difference between what uh, what is the professional attitude and what is not. But then this comes from a training. I mean, training means uh, uh, rigor, right? Training is cannot be training. If you underperform, you get reproached. It's better to be reproached than penalized. You understand? If you get reproached, at least you don't get penalized. But some people think they are adults and they cannot handle their own emotional state and just blow up. I mean, not only it's not because of uh, the matter at the core, right? In other words, they just complain because it's hard for them. And if it is hard, this is a training. The goal is the bar is set above you. The bar is it cannot be set below you. If the bar is set below you, that's not a training. You don't achieve anything. If anything is the bar is below you, then uh, even a second grader can do anything, right? Always the bar is set above or at a challenging level for that cohort group, right? And in a training, you get so think about a military boot camp. Are they pampering in the military boot? If you're in the military, are you there to get pampered? Hmm? This is the same thing. This is the same thing as intellectual military boot camp. This is the same thing to martial arts, intellectual martial arts. You have to really treat yourself harsh, right? Like a sun training. If you think you're in a military boot camp, you think you will have a party, uh, they will pamper you with ice cream and strawberry and champagne. And the mindset and mentality of the complainer, just like that. Anything, if it is not, if it is too hard for them, they just complain. Not thinking of pushing their envelope, not thinking of trying harder to reach that raised bar, they just complain. They complain for being chided, they complain for being reproached, but if you're an adult, you should know you're doing it for yourselves, to make yourself smarter, make yourselves more capable, make yourself more rational and scientific, to turn yourselves into a scientific and rational thinker. But if they are incapable of following that, then they complain. It's not something to complain about. You're not doing this for me. I know this stuff. That's why I'm teaching you. That's why I'm the professor. And someone in this role, right? Someone in the role of a trainer, someone in the role of a boot camp drill sergeant is charged with the responsibility to reproach the underperformers, to chide the underperformers. Boot camp drill sergeant is not a caregiver. And some people who are crying and complaining, they are, what were they expecting? Expecting a caretaker? And get out of that mentality. You got to if you're a complainer, you got to get out of that mindset. Who gives you, in what class do you learn like this? And it is something like this is only for people who have that strict mind, a strict, disciplined mind. This is for mature people, not immature people. This is not for immature people. If you're mentally immature, then you cannot understand any of this. You'll just always say, it's too hard for me. If it is too for you, push yourself. Right? That's what they do in the military boot camp. And I've been telling you, this is like intellectual boot camp, intellectual martial art class. You get in a martial art class, you get kicked, you get hit, of course. You're learning martial art. Getting kicked and getting hit is all just part of the training. Some people cannot take it. Some people think their ego is hurt. So what about that ego? What ego is, in a martial art class, then if you got kicked and if you get, hit and you get hurt emotionally and then cry and then complain, then you don't belong in the martial art class. Isn't it right? You don't belong in the martial art class at all. You will never get stronger. You will never learn, be able to defend yourself. And in an intellectual martial art class, if you are crying out and complaining because your ego is hurt, because you find yourself below, average intellectual level, then you cannot get smarter. You cannot get, if you're crying because of that, without complaining because of that, without making efforts to push yourself and to push your envelope, right? Then you cannot belong in an intellectual martial art class. You know? So anyway, back to I really don't want to digress from the lecture, but when it comes to that, it's inevitable, right? Some people don't wake up ever, so never wake up from their and never break out of their own hard shell. Now, so this was the regression result of the Apple for that period of 5 years, 2011 through 2015. And the slope of this trend, so these were actual scatter plot of Apple. The slope of the line was 0.875, and the vertical intercept was 0.0115. That means when market is zero, market return is zero. Apple's return is at least zero. So the market return is Apple's return will be at least 0.0115%, right? And if market return is like, this one fell exactly on the straight line. Market return was something like 8.2%. Apple was. In the past, it was like Apple was somewhere like 7.5% or something. This looks more like 8%, 8 point something. So with beta, then what can we do? Now, beta by itself, there are two things that beta can do. One, of course, when beta measures the systematic risk, right? And I told you the part of the variance that comes from the correlation with the market is called volatility, right? So beta is the measure of the volatility. And so when you using what you can do is you can construct a portfolio with varying degrees of beta. You may not. I said, systematic risk doesn't go away by diversification, but non-systematic risks can be diversified away. But still, non-systematic risk of individual stocks can be reduced to the systematic risk. If you construct a portfolio with varying degrees of beta, then the systematic risk can be of the portfolio, systematic risk of the portfolio, not individual stocks systematic risk, but the systematic, not individual stocks beta, but the beta of the portfolio can be reduced to 1. Right? 1 is what? If the beta is 1, what does that mean? It is the market's risk, simply the market's risk, right? If Apple's beta is 1, what does that mean? If market goes up by 10%, Apple goes up by 10% as well. But then the downside is, if market goes down by 10%, Apple is going to go down exactly by 10%. But the portfolio beta, if portfolio beta is exactly 1, then that means what? The volatility of your portfolio will be just the volatility of the market, no greater or no less. In other words, no worse, no better, right? And you might wonder, wouldn't you want it to be better? Don't you want the portfolio beta to be zero? No, you don't want the portfolio beta to be zero. Why? Because if zero means there is no exploitable correlation between the market and your portfolio. That means when market goes up, your portfolio does nothing. It doesn't go up at all, right? When market goes down, it doesn't do anything to the portfolio, right? So is that what you want? Huh? But if market is doing well, you want your portfolio exactly also replicate the market's result or better. I mean, if the portfolio beta is 2, yeah, market goes up by 10%, 10%, your portfolio will go up by 20%. But then the downside is market goes down by 10%, your portfolio will fall by 20%. So you don't want that. You want your portfolio, I mean, to move just as only as much as the market. You want the volatility to be only as volatile as the market. In other words, high positive beta is good when market's doing well, but when market's doing badly, high positive beta is bad because you will. But you don't want the portfolio beta to be negative or zero because then. So anyway, get the idea. Constructing a portfolio with varying degrees of beta to bring it close to 1, and your volatility will only be as much as the volatility of the market. That's the reason. Right? Second use of beta is the use of beta in capital asset pricing model, or CAPM. CAPM is, it's a little misnomer. Why? Why is it a misnomer? Actually, it doesn't. Capital asset pricing model doesn't directly price any asset. Okay, so capital asset pricing model is actually the model to calculate the required return. You understand? The required return is what? The discount rate used in the stock pricing model. Remember, dividend discount model. And in the dividend discount model, there is always required return. And it was given all the time. I mean, and I told you, we are taking it as given. But in reality, there is no such thing as given required return because every stock is different. Every stock's risk is different, right? There is nothing given. You'll have to find it. You'll have to calculate it. And to calculate it, it has to be, since every stock has a different risk, different systematic risk, different beta, in other words. Every stock has different beta. So you need a required return that is adjusted for the beta that's specific to that company. Make sense? So CAPM is the model to calculate that risk-adjusted, in other words, beta-adjusted required return. Of course, another notation for required return is capital cost of equity, KE, K sub E. Remember, cost of equity. So here, this notation is all, cost. So let's take a look at the CAPM. CAPM is basically the difference, the linear function. If you may have noticed, you should notice, basically it's a linear function between market risk premium on the market and individual stocks risk premium. Now, take a look at this. This is what is risk premium? Risk premium is the excess return over the risk-free return. And you all understand what risk-free return is. The return on the treasury is risk-free return. Remember that short-term treasury bill, like short-term treasury bill, 3-month treasury bill is considered risk-free because there nothing is safer. We did this over and over from the day one. Nothing is safer than the U.S. Treasury. Everyone remember that? So if nothing is safer than the Treasury, right? Think about it. So your return on the Treasury, 3-month Treasury or 1-month Treasury is risk-free, right? So even if you don't take any risk, right? Even if you don't take any risk, you can still do, if risk-free return on the Treasury is 5%, know what? Without taking any risk, you can still earn 5%, right? Makes sense? And then if Apple's return is 15%, right? That's not all. 15% is not all thanks to Apple, right? It is 5% is anyway something you earn without taking any risk. But so the pure return to Apple, solely due to taking risk by investing Apple, is 15 minus 5. In other words, the return over and above the risk-free return. That's called risk premium because it's the premium is what? Premium is like the reward, right? And that 10% is the reward for taking a risk greater than taking no risk, right? In other words, if you put your money into treasury, you're taking no risk. So if you're taking a risk by investing in Apple, whatever is earned over and above risk-free return is the reward for taking the risk. So that is called risk premium, right? And then suppose you just, rather than Apple, you just, buy an average stock. Okay, average stock would earn average market return, right? So average average return on the market. How do you? It's the return on the market portfolio. Market portfolio is a hypothetical portfolio where you have every stock traded in the market, one share each, right? One share each. And of course, in reality, it should be exactly like in the weight of each. Think about it. The market capitalization of General Motors or General Electrics cannot be the same as the market capitalization of a small company. But anyway, ignore all that. Let's say what would represent the market? S&P 500 index would very well represent the market because in S&P 500 there are 500 companies that are most representative of the U.S. economy, right? 500 sectors that represents, the best performer, right? in each industry, right? Of 500 industries, right? So if you have one share of each of these 500 companies, then you have a market portfolio, and the market portfolio. So then it's a hypothetical portfolio, but the return on the market portfolio is simply what? Return on the S&P 500 index, right? So if you just buy on average stock in the market, right, you're taking on average risk, right? Based on, and then even if it is just an average stock would have a risk, and average stock would have a risk and greater than the risk-free. So obviously, if S&P 5 on average the market earns 10%, right? The difference between the risk-free return and the market return is called market risk premium. In this case, 5%. And then, so think of this as Y, right? Cost of equity on X minus cost of this is risk-free return, right? So Apple's risk premium, that is Y, and this is X, right? Market risk premium is X. And think about it. X is the independent variable, and Y is the dependent variable. And think about it. I've been telling you, market is the independent variable because no company is free from the market. No individual stock is insulated from the market, right? So if market goes up, most stocks are cyclical, they go up. If market goes down, most stocks go down. Makes sense? So just like a linear function, right? It's a relationship between the excess return on or risk premium on Apple and the risk premium on the market. And y equals this specification, y equals x times beta. That means what? If Apple's beta is 3, what does that mean? Apple's risk premium will be 3 times the market's risk premium, right? Doesn't that make sense? Why? If Apple's beta is 3, that means what? Apple is 3 times more volatile, 3 times as volatile as the market. So then isn't it only rational that Apple's risk premium should be 3 times the market's risk premium? Because Apple is 3 times more volatile, there will have to be, 3 times the compensation for that 3 times more volatile stock. The compensation for that must be also 3 times the return on the market. Make sense? Hmm? So in other words, let me use this analogy. What is the average life what are the chances of dying in line of duty? I mean, if you're an average worker in New York City, average office worker in New York City, what are the chances of dying in line of duty while in other words, while you're at work? Huh? But let's say the chances of that is 10%. But what are the chances of New York State firefighter, I mean New York City firefighter or police officer dying in line of duty? The chance, let's say that's 30%. That's like 3 times higher than the average office worker in New York City, right? Average white collar worker in New York City. And what are the chances of dying in line of duty for a military, a member of armed service, for example, Navy SEAL, or Special Green Beret, or Special Task Force teams? They would have much higher chances of dying in line of duty. Maybe they're 60%, let's say, and then that's 6 times average white collar worker in New York City. Make sense? Then suppose the uh, salary is based on this risk level solely on, of course, salary is the factors that determine salary is not only the risk factor, but let's say risk factor is the only factor that would determine uh, the salary. Then what? Um, uh, New York City police officer and firefighter, uh, their salary should be, if they are, chances are 3 times average, worker, then shouldn't it be compensated by 3 times? In other words, if this is, average worker makes, $50,000 a year, let's say, then if New York City, somebody who's doing, more dangerous work, right? Uh, and if they are, 3 times their risk of, dying is 3 times, then shouldn't that be 3 times the average worker's compensation, right? Make sense? That's the logic behind CAPM. Apple's risk premium should be if Apple's beta is 3 times, because that means Apple's 3 times riskier than average the market, average of the market. Then um, that is captured by beta. That volatility is captured by beta. So Apple's risk premium must be 3 times, right? Average, risk premium, market risk premium. Then, so this is a linear function, y equals x times a beta format. Then what we are interested in is only not the risk premium per se, but required return, required return on Apple. So then to isolate only required kx, required return for Apple, then you move this to the right-hand side. Then it becomes this. So this is CAPM. This is, how you calculate the. So then now with this, you can measure. You can plug that required return into DDM, dividend discount model. You understand? That required return in dividend discount model came from CAPM. Right? That's why I said, CAPM is a slight misnomer, because CAPM by itself doesn't price anything. It just gives you the required, it allows you to calculate the required return. Okay, so basically, CAPM is derived from a security market line. Security market line is basically what you are plotting the return against beta. Of course, security market line would increase as the beta increases, right? In other words, required return should increase as the beta increases. I mean, the higher the beta, the higher the required return, right? Okay. So that's it. There's a lot more to talk about the security market line, because you will see there is a capital asset allocation line, and a capital allocation line, capital market line, security market line. There are similar graphs you will see along the way, but we don't have time. We're out of time. We're actually like 10 minutes past the so it's like 70. It's been like 70 minutes. So I don't think the video. I mean, I cannot even post it on YouTube because the file size is too large. You might wonder, Professor, why don't you post it on YouTube? It can't. The YouTube maximum is like minutes. This is like every lecture is like 60 minutes at least. There's no way it cannot be processed on YouTube. I would like to, so you can only you can only watch this video on the blackboard. Maybe in the future, I may be able to figure out a way to cut it up using, like a video maker, uh, into a smaller segment, like 30-minute segment, and then post it on YouTube. But now at this point, it's only on the blackboard. Alrighty, so that's the end of it. That wraps up everything about the risk and return, and that's the last topic of this semester. All right, and for this course of Principles of Finance. Thanks for watching, and good luck with your final. And we'll see you guys hopefully in the next semester in advanced level courses such as Finance 300 investment analysis and Finance 230 corporate finance. Thank you for watching, and end of video.